Hi, in this video, we will talk about the what's, why's, and how's of decentralized finance, or DeFi.
Before we go deeper into our topic, let's find out first the history of decentralized finance, which is widely known as DeFi. In 2009, it was argued that Bitcoin, the first peer-to-peer digital currency based on the blockchain network, was the beginning of DeFi. After Bitcoin utilizing blockchain technology to transform the traditional financial world became a critical step in decentralizing legacy financial systems. All of this was made possible in 2015 by Ethereum and smart contracts. The Ethereum network is a second-generation blockchain that was instrumental in maximizing the financial potential of this technology. It sparked the development and deployment of DeFi-related projects by businesses and organizations. So what is DeFi? Decentralized finance is a blockchain-based financial system. Instead of relying on a central financial institution, smart contracts are used to conduct transactions. DeFi intends to establish a new financial environment that is open to anyone and does not rely on any third party. Instead, consumers have trust that the technology will work as expected in order to carry out the services that are being delivered. It's a bit confusing, right? Don't worry, we will explain that further. We can think of the blockchain as a concept similar to a book in which we record information. A blockchain can be considered a ledger where contracts and transactions are recorded and stored. In simple terms, it is a database that saves encrypted blocks of data and then links them together to create a single chronological source of truth for the data. Transactions on a blockchain might be more or less private or anonymous depending on how the technology is implemented. A smart contract is a computer code that serves as a digital agreement between two parties. Because the smart contracts are processed on the blockchain, they can be sent automatically without the involvement of a third party. One advantage of smart contracts is that they can borrow and lend cryptocurrencies without an intermediary, eliminating many of the risks associated with traditional lending. So, this explains the definition of DeFi. Again, decentralized finance is a blockchain-based financial system. Instead of relying on a central financial institution, smart contracts or codes are used to conduct transactions.
In order to understand how DeFi works, we need to understand first the building blocks that comprise it. But before that, we want you to know that in order to create a decentralized financial system, we need an infrastructure for programming and running decentralized services. Luckily, we have Ethereum. Ethereum is an open source blockchain with smart contract functionality. It is a DIY platform for writing decentralized programs, also known as decentralized apps or dApps. It allows people to connect directly with each other without a central authority. Using Ethereum, we can write automated codes or what we call smart contracts that manage any financial service we'd like to create in a decentralized manner. This means that we determine the rules as to how a certain service will work. Once we have a system in place like Ethereum, we can now proceed to the building blocks that comprise DeFi. The following are the 6 components of DeFi. Lending and borrowing. DeFi lending allows clients to deposit fiat money and earn interest through dApps or decentralized applications. They can borrow money from the network and repay it with the interest and borrowed funds within a certain deadline. An advantage of this is that it is much faster, has a cheaper rates, but with high profit. And in the process of lending and borrowing, no middlemen, no banks, no other intermediaries, meaning there will be no fees associated with the loan. Stable coins. Stable coins are cryptocurrencies that are pegged to the value of a real-world asset, usually some major currency like the US dollar. Stable coins, unlike Bitcoin and Ether, are not highly volatile, as it gives a more dependable alternative that seeks to combat price swings. Stable currencies can be used for a variety of things, including trading goods and services, making international transactions faster and cheaper, decentralized insurance solutions, derivatives agreements, and granting and taking out loans. Decentralized exchanges or DEX. Decentralized exchanges are cryptocurrency exchanges that use a peer-to-peer network to link buyers and sellers and allow users to conduct transactions. DEX facilitates financial transactions that aren't facilitated by banks, third parties, or other intermediaries. Since it is decentralized, it runs according to a system of rules, executes trades, and securely handles funds when necessary, or smart contracts, which allows clients to trade, buy, and sell cryptocurrencies. Derivatives. Derivatives are contracts whose values are generated from the performance of an underlying financial asset in the decentralized finance industry. Commodities, equities, interest rates, bonds, currencies, market indexes, and other underlying assets are among them. Anyone can build a contract tied to an asset using DeFi derivative markets. These are also more accessible because no confirmation or identification or eligibility is required. Margin trading. DeFi crypto margin trading is the utilization of borrowed funds, which purpose is to have an increased position in a certain asset. In this component, the financial asset that is being traded is the collateral for the loan. Moreover, it has two main components, leverage and shorting. Leveraging is when a trader borrows assets to increase the number of assets they are trading. Shorting is when a trader borrows an asset to sell, expecting the asset value to decrease. Insurance. Insurance is a part of the decentralized ecosystem that ensures payout guarantees in exchange for a premium. Insurance is often utilized in the DeFi area to cover deposits and secure against smart contract failure. Since we already know about the components of DeFi, the history, the meaning, the other terms of DeFi, we can now proceed and answer the question how DeFi works. So DeFi represents a system of financial products built on top of the centralized and open source blockchain. As discussed earlier, unlike centralized finance, DeFi has no middlemen, no banks, or other intermediaries to facilitate access to finance and transactions. DeFi offers higher level of financial access by offering the possibility of a suite of financial products built on no permission blockchains. Financial products and services, or some of the components I discussed earlier, such as lending, borrowing, saving, exchange, insurance, and more, can be programmable to the blockchain. With that, clients can interact with each other, again, without the help of any financial institution that traditionally provided the service of intermediation. Aside from providing an alternative to the traditional financial products, DeFi provides a platform for fresh innovation and regulatory issues. The blockchain and cryptocurrency area has recently seen tremendous growth, and it is increasingly being recognized as a potential disruptor to traditional centralized finance.
Why DeFi can replace traditional finance? Traditional finance are held by an institution or custody provider, while in decentralized finance, it is held directly by users in non-custodian accounts. It is also facilitated via smart contracts, not intermediaries, like the traditional finance. Traditional finance relies on procedures used to authenticate a client's identity and legitimate before doing business with them. A credit check, identity verification, and probably another kind of income verification are required if you want to borrow from a bank. However, with decentralized finance, the client can frequently stay anonymous and keep their details and identity hidden. Typically, the only thing required is digital assets. Rather than going through banking firms, DeFi clients enter into smart contracts. In traditional finance, if you want to get a loan, you would have to go to a bank and a lot of time will be wasted. With DeFi, you can get a loan with just one click, even in the middle of the night. You can access the market from anywhere and anytime as long as you have an internet connection. Apart from that, many traditional banks set a minimum deposit when opening a bank account. In addition, most accounts charge a minimum balance fee or a maintenance fee. DeFi is unique in that all you need is a cryptocurrency wallet and an internet connection, and there is usually no requirement for a minimum amount of money. However, if you forget a password for an account, it is lost completely. There is no one else to turn to for assistance. Interest rates on DeFi are more than 10 times higher than those offered by traditional banks, and using stablecoins eliminates the need to be exposed to the volatile cryptocurrency market. The features that distinguish decentralized finance from traditional finance include sphericity, accessibility, ease of value transfer, and efficiency. What are the risks in DeFi? Smart contract risk. Any flaw in the code can lead to loss of funds. Smart contract risk is arguably the most significant disadvantage of decentralized finance. Instead of centralized custody and servers, people involved must trust that smart contracts do not contain any threats or risks that could endanger assets. The most prominent attack involved the use of code bugs and also the deception of external price feeds for assets within protocols known as price oracles. Scalability. Since every transaction must be encrypted and validated by a majority of network nodes using complex cryptographic algorithms before it can be logged, blockchain networks have a lower capacity for verifying transactions. For example, Ethereum could process nearly 13 transactions per second at full capacity, while other financial services could handle thousands of transactions per second. Impermanent loss is one of the common risks of lending on DeFi. The volatile nature of crypto tokens is the primary reason behind impermanent loss. Investors have to lock their assets in liquidity pools for DeFi lending, and the charge in price of the assets after depositing them in the pool creates an impermanent loss. It is a loss that you have to incur when the price of the assets you have deposited changes between the time of deposit and time of withdrawal. You can only find the loss when you have withdrawn your deposits from a liquidity pool. Hacks and other exploit attacks. Investors are uninsured that the occurrence of a hack and other malicious transactions due to coding mistakes, flash loans, price manipulation, and minor attacks. The industry is risky and prone to scams due to inadequate regulation. DeFi apps have also grown in popularity as a platform for money laundering. According to Chainalysis, a blockchain data platform, criminals laundered approximately $8.6 billion through DeFi in 2021. The market risk of incurring a loss due to asset or market price volatility exists in DeFi because crypto is a volatile asset class susceptible to hacking, arbitrage, and market manipulation. The journey to the development of a credible DeFi environment is full of risks, challenges, opportunities, and needs that must be navigated with vigilance. To address the evolving challenges and make relevant contributions, all parties must have clear vision. That's it for this video. Thank you for watching. I hope you enjoy it.